The Goodman Wave Theory is a complete trading method for stocks, commodities, and currencies. GWT is logically constructed from two very old market ideas, the 50% retracement rule and the measured move rule. GWT is transparent, easy to understand, and you may use and apply it after learning only the most basic rules. It has three substantial advantages over other wave theories, including Elliott, which we will identify in this tutorial. GWT itself has two components, the Goodman Swing Count System, GSCS, and the Goodman Cycle Count System, GCCS. This tutorial will discuss GSCS. Part 2 will discuss GCCS. In GSCS, a swing is a price move up or down with less than a 25% correction. The price action on the left is a single swing. The price action on the right is composed of multiple swings. In GSCS, a 1, 2, 3 or ABCD, if you measure from points, is a matrix. An ideal matrix is a measured move. Swings 1 and 3 are of the same length, and 2 is 50% of 1 and 2. 1 and 3 are primary swings. 2 is a secondary swing. The 1, 2, 3 matrix is the basic chart component in GSCS, unlike Elliott, which has a 1, 2, 3, 4, 5 basic chart component. Matrices are said to propagate. A 1, 2, 3 matrix once formed becomes the 1 swing to a larger matrix. Thus the 2 swing of the larger matrix would be the 4 swing in Elliott. Nesting is the same as propagation, but from the outside in. Matrices propagate and smaller matrices are said to be nested in larger matrices. You may conceptualize this as the interaction of traders at different price levels, scalpers, day traders, and position traders. Here is the first difference between Elliott wave theory and Goodman wave theory. In Elliott, the 4 swing is related to the 3 swing. In Goodman, the 4 swing is the propagation swing of the entire 1, 2, 3 swing. In Goodman, 4 is related to the entire 1, 2, 3. The 4 swing is critical to proper analysis of a market. In Goodman, it is called the return swing. Here is how matrices propagate in Goodman. Prices always propagate to 2 levels, frequently propagate to 3 levels, often propagate to 4 levels, and occasionally propagate to 5 or even 6 levels. A matrix propagated to at least 2 levels is a Goodman wave. The Goodman wave is the basic market paradigm. Our goal is to get aboard a wave at some high percentage point and ride it as far as we can. By using the overlay concept in GWT, we increase our chances of success. Possibilities are decreased instead of increased in GWT. This is another way to look at a swing in GWT as points. Every swing has 5 points. The 1 point is the beginning of the swing, the 2 point is the midpoint of the swing, the 3 point is the end of the swing. The 4 point is the measured move of the swing, and the 5 point is the opposite measured move if the swing in question is a 2 instead of a 1 in a matrix. The 5 point is tricky. Keep in mind any swing can be both a 1 or 3 primary swing in one matrix and a 2 secondary swing in a larger matrix. The 3C rule is the second difference between Elliott and Goodman. The 3C rule is the method for measuring swing and matrix price objectives. By confirming a propagation analysis, the 3C rule eliminates possible multiple forecasts and helps confirm one forecast. Instead of more possible forecasts, you zero in on just one. The most important part of the 3C rule states, if the 50% retracement of swing 2 is over or under 50% in swing 1, The difference will be made up in the measured move of swing 3 of that matrix. The initial count is always taken from the 50% point of swing 1 and gives an over-under count for swing 3. Work with the 3C rule on some charts. You will be amazed how effective and accurate it really is. Again, the 3C rule is an overlay tool. With Goodman Wave Theory, each level of analysis eliminates possible forecasts and adds confirmation to just a single forecast. This chart shows a two-level propagation and the return point for the larger matrix. One can find excellent trading candidates simply by looking for good return points and swings, and then adding confirmation by overlaying the 3C rule count. The 4 swing often behaves irrationally for traders because they think it only is related to the 3 swing, but as we have seen, it is related to the entire process, 1, 2, 3 matrix. Here is another example. In GSCS, only price matters. The trader needs to ignore the time element to see the swings and the matrices effectively. Another return swing example. The red return swing is connected to the entire black 1, 2, 3 matrix, and not just the 3 swing of the black matrix. The black matrix has propagated into a larger red matrix. Goodman analysis is about accurately forecasting propagation of matrices. This is an example of the third unique feature of Goodman, intersections. An intersection is a price point where the points of two matrices coincide or intersect. An intersection is a price point where equilibrium at two different price levels coincides. Definitely a place to watch what happens next. Intersections identify support and resistance that other traders do not see. There are a large number of Goodman intersections and they are called templates. Each template has its own set of characteristics and probabilities. Here is a very common intersection, the measured point 4 of one matrix intersection with the measured move point 4 of a larger matrix. Another often seen intersection, the measured point 4 of one matrix intersects with the 50% point 2 of a larger one swing. Like the 3C rule, intersections are an overlay, helping to eliminate multiple propagation forecasts and confirming only a single forecast. Here is another intersection. When 2 points coincide, it is a double intersection. When 3 points from different matrices intersect, it is a triple intersection. Both are common in all markets. Triples are difficult to see without extensive experience or a computer-aided program. The more intersections, the more the point is confirmed as significant and the propagation as valid. And here is an example of a triple intersection, not the sharp up move out of the triple intersection. Part 2 of this video tutorial will discuss GCCS. GCCS is a rule set very nearly identical to GSCS used for time. GCCS is yet another Goodman Wave Theory overlay that helps eliminate multiple forecasts and confirms a propagation forecast. The intersection of a GSCS forecast point and a GCCS forecast point is called a landing area. Landing areas are not particularly rare, but they are difficult to find without experience or a computer assist. You may visualize a GCCS analysis by rotating a chart 90 degrees, making time the vertical axis instead of price. And here is a single chart example showing propagation, return point, double intersection, and the 3C rule. This was a near-perfect GSCS setup with multiple overlays confirming propagation forecast. Part 2 of the Goodman Wave Theory tutorial will discuss the Goodman Cycle Count Systems, GCCS. The Goodman Codex includes the complete writings on all the Goodman market theories and methods. Goodman Swing Count System, Goodman Cycle Count System, and Market Environments, ME. It is updated with new articles monthly. Limited email consultation and mentoring is provided to purchasers. Thank you for viewing Part 1 of the Goodman Wave Theory tutorial. Trade the best and leave the rest.